In the next few minutes, I would like to explain the topic that is known as capital market efficiency. It has to do with why stock prices, or maybe not stock but bonds or other financial securities, but let's stick to stocks. Why do stock prices change so much all the time? You might know that stocks for Apple, Facebook, Google, and thousands of other companies are fluctuating on a daily basis. Why is that? That's what this topic is about. On this figure, I have Google stock for year 2008 and 2009, about 12-month period. And it shows that the price is going up and down, up and down, up and down, right? Some big fluctuations and small ones along the way. And there are a lot of things which are highlighted for, especially for the times when there were big drops or big jumps. Like Bing launch is marked here. Google to buy some company is marked here towards the end. Yahoo, Bing deal, Google lays off sales and marketing people. Somebody says that the economy is pretty dire. Things like that. So it could be some announcement made by some economist or some big maybe merge by some competitors in the same area of business, or somebody said something about Google, or Google did something, right? So it's all the different things that happen that affect Google and how much people are willing to pay for Google stock shares that are actually the reason why stock share price fluctuates so much and so often. So it all has to do with the information that comes in that somehow makes people more hesitant to buy the shares, and so the price drops, or more willing to buy the shares, and so the price jumps. So it has to do with the prices adjusting to the new information that arises. We say that the stock market is efficient if, when something new happens that affects the stock price adjusts quickly and correctly when that new information arrives. That's the capital market efficiency. And the so-called efficient market hypothesis says that the capital market, such as the New York Stock Exchange, is efficient. Some researchers out there believe in it, others do not believe. Those who do not say that when something new comes in, people sometimes overreact or don't fully understand the implication of that big news, big announcement, and so the prices do not reflect that accurately. Okay, on this chart we show the reaction of stock price to new information in efficient and inefficient markets. So 0 means the day when some announcement is made by some imaginary company. -2 means 2 days before that announcement will be made. Nobody knows about that announcement. People don't know about it yet. -4 means 4 days before. +2 means 2 days later, after the announcement has been made in the news, like became public information. And on the vertical axis, we have price per share in dollars. So up until the announcement is made, the price per share is $140 flat. Then this announcement is made. Does it look like the announcement is good or bad? Probably good, because the price goes up, right? People wanna pay money. They believe in the company doing better in the future following this important announcement. And if the company would be doing better in the future, the company managers would be able to increase the amount of dividend that they're paying to all stockholders. Okay, so we have kind of three ways how the price goes up following this announcement on the announcement day. We have a step, the solid blue line. If the step happens, the price immediately jumps to 180 per share. Then we have the light blue dotted line. The price kind of goes to about 220 and then goes back to 180. And the orange broken line, where the price slowly goes up to 180 over the next several days. Which one of these three adjustments to the new information is efficient, and which one or which ones are inefficient? This step, the solid blue line, is efficient for two reasons. The definition of efficiency is quick and correct adjustment. It's quick because the announcement changes the price right away that same day. It's correct because it stabilizes at the new level right away and stays there. It doesn't change anymore. That's why the solid blue line reflects efficient market reaction. What about the dotted blue line? It's inefficient because it overreacts. It does not adjust correctly. And remember, adjusting correctly is half of how we define efficiency in finance. So it does adjust right away, but people overreact. They interpret the news as something being way too good. They're paying way too high price, and then they realize it's not worth it, and then the price goes down and settles. The broken orange line is also inefficient. It means a slow adjustment. The price does start reacting immediately, but it takes a while until it settles at the correct new level. So only the solid blue line, which looks like a step, reflects efficiency. The other two are examples of how we could have an inefficient market. What about something like this? So it's not in the book, I edited it myself, the red line. So it shows how the price, actually let me fix it. It should be more like this, okay? So it's at 140, then it starts going up a few days before the announcement is made, and then it settles at the new level. What does it mean? Is it efficient? Is it inefficient? What does it mean that the price starts going up before the announcement to the public is made? This is what we call insider trading. So somebody working in the company who knows what will be announced before the other billions of people on this planet, and they use this information to start trading that would make them benefit from the trade. So for example, they know already that the price will go up. How can they benefit financially? They can buy a lot of shares now because just a few days later they can sell it for more money and become rich. And so if hypothetically, if there are a lot of insiders working at the company who know that information and who will start using it for their trades, that may affect the price. A high demand makes the price go up. But this is something that is considered illegal. You cannot trade stocks based on the information that is considered to be an inside information that is not known to everybody else around you. It's not legal to do that. You can go to jail. Okay, so now what makes markets efficient? Basically, what makes them efficient is the fact that there are advanced computers in our life these days. There are people on Wall Street who are paid $500,000 a year, $1 million a year to do, the only thing they do is, you know, gather information on different companies, write sophisticated codes for programs that analyze, let's say, the content, the keywords in that information, and try to predict where the prices are going. So it's because there are a lot of investors out there doing research, gathering information on companies, trying to be the first to sort of beat the market, the first to find something new out and make the right next move, buy or sell a lot of shares of a specific company. And all this information these days is processed in seconds, right? Back in the days when there were no computers, no internet, it probably takes a while for some information to be delivered to people around the country, right? So back then, the markets were definitely inefficient. These days, they are, if not efficient, then very close to be what we call efficient. And so in theory, if let's say investors are stop researching stocks, let's say internet goes down, right? Phone lines go down for a month. Then if something like that happens, it will be taking a lot of time for the information to spread and be known to the public, which will make the stock market not efficient anymore. And then another thing that's part of this whole capital market efficiency topic in finance is three forms of market efficiency. Weak form is when you research prices on shares of stock of different companies. And let's say your analysis shows that all that the prices reflect, like the reason they went up or down, the only information they reflect is the past information. And that's what researchers kind of mostly agree on these days, that that's all the prices reflect. What would be a different amount of information that could be reflected? Semi-strong form efficiency. That's not only past, but also all publicly available information. Everything that's known about the company today. Any press releases, any annual reports, anything about trading going on today in the past days. Everything out there is what people look at to determine how much they're willing to pay per share. And that's what determines the price per share. If that's the case, we say that the market is semi-strong form efficient. Now, if you also add, so if you have past information, today's publicly available information, and private information, meaning something about the future, right, that only some people know, but not the rest of the public. If that's how the prices change, and that's kind of what I showed earlier with the red line, right? If private, group of people trade based on what they know about the future, right? If this is how stock prices are changing, if they imply that the information reflects that the prices reflect information that is not publicly available yet, such as private inside information, then that would be called as the strong form efficiency. Okay, but that's not what the empirical evidence suggests. So researchers show that this is definitely not what's happening. Maybe semi-strong form efficiency, but it looks like it's weak form efficiency. Okay, let me show you one example to complete this topic, to kind of, clarify what it all implies. Let's say you have a neighbor. He trades stocks all the time. And you know that he's constantly overhearing things at his workplace. He gets access to some confidential information, and that's what he uses to trade stocks. So he overhears something that will happen in the company. If it's something good that will make prices go up, he buys a lot of shares because he knows that the price per share will go up, and he will sell the shares then and make profit. Okay. So this information he's using for his trades is not available to the general public. This neighbor continuously brags to you about the profits he earns on these trades. This is the important sentence. He brags to you about all the profits he earns on these trades based on the inside information. So he makes profit based on the inside information. Given this, this implies that the financial markets are, at best, form efficient. What's the right answer? The right answer is D, semi-strong. Because if the market was strong form efficient, it means what? It means even though he has access to private information, it's already too late. It's already reflected in the prices. He cannot make profits. But because he can make profit based on the inside information, it means the market is not strong form efficient. So either semi-strong form or weak form. At best, semi-strong form. That's the answer. Semi-strong form efficient. So the other options would be weak, strong. We talked about strong, semi-strong, weak. Semi-weak, this term does not exist in finance. Perfect, it does not exist when we talk about market efficiency. So only your choices should be only between strong, semi-strong, and weak. And in this particular case, D, semi-strong, is the right answer.